Bill Dudley, describe transitory on the way down. I don't understand that. How do we have transitory disinflation?
Well, remember, goods prices went up dramatically because during the pandemic, people bought a lot more goods and bought a lot less services as they stayed home. Now we're on the flip side of that. They're buying less goods, more services. So goods prices are very weak, and they're going to be very weak for a while as people manage their inventories down. But once that comes to an end, then goods prices will level off. And so the benefit to headline inflation from falling goods prices will be over, and you'll be stuck with what's happening in the services side. Look, I think this is a very good report today, and the Fed should be pretty cheered by this. But I don't think it changes what they're going to do at the July meeting, because I think that they said that they're looking at the totality of the data over the last 3 months going into the July meeting. And the reality is the economy is still doing quite well. We had 2% growth in the second quarter. If you look at the LATF Fed GDP Now tracker for the third quarter, it's at 2.3%. So the economy really hasn't slowed down enough to make the Fed confident that they're going to see that slack in the labor market that they want. What I think this does do is opens up the question is, could July be the last one? And that's certainly possible, because they won't move at the meeting after July. They'll take a break just like they did this last time, and then we're going to get to November 1st. Well, there's a long time between now and November 1st. I can imagine by that point it's possible that they'll see enough news that makes them confident that they've done enough. So I think the November rate hike is really up for grabs at this point.